Check. Okay, so let us now start today with our very first live batch for Inter CA Financial Management. And guys, this particular batch is going to be a regular course batch applicable for Jan 25 as well as applicable for Jan 26 as well as May 26. And we are going to cover each and every chapter comprehensively by referring to all the study module concepts, then all your RTPs, past examination papers, and guys, the entire course, this is going to be in your English language. So I hope you all are ready now. Let's get started now with the basics of financial management. Okay, so without wasting any further time, also this particular batch will be held on every Monday to Friday from 2 p.m. to 4 p.m. Okay, so what you have to do is just keep your notebooks handy with you, keep your calculators handy. And today, because it's a very first day, we are just going to do introduction about financial management. I'll be giving you some important uh, inputs about how do you have to prepare for financial management, which all things will be covering it here. And also at the same time, we will be solving all the practical problems. Okay, so be ready with your calculators. And first of all, let us now start with what financial management is all about. Okay, so I just want you all to take a note of this as well. And this should be your very first page of your financial management. Okay, so introduction about financial management. Now, my dear students, when we are going to deal with financial management, okay, so basically management of finance, we are going to do for which type of an entity? Because management of finance is possible for proprietors, for partnership firms, for trust, AOP, BOIs, companies. But this entire subject of financial management, we are going to study from the company's perspective. Okay. So entire financial management at CA Inter level, think that you are a CFO of a company and a chief financial officer is going to manage the finance of the particular company. Come on, yes or no? Yes, sir. So this entire financial management course is based on the perception that you are going to be the CFO of a company and you are going to manage the finance of a particular company. And guys, what do you think? A CFO is going to just manage accounts or pass entries? Of course not. Is the CFO going to be involved in decision making process? Come on, yes or no? Of course, yes. So in this entire subject, we will be discussing how to make decisions for a particular company to manage finance, thinking that you are a CFO of a particular company. Okay, so whenever you're going to study financial management, just think that you are a CFO and you are going to make decisions for the financial management of your company. And guys, every decision, whatever you make, is going to be based on some particular objective. Come on, yes or no? Of course, yes. Okay. So let's say, for example, you have decided to become a chartered accountant. So there is an objective attached behind it. Come on, yes or no? Yes, sir. Also, at the same time, you have decided that, you want to pursue your commerce or like you want to pursue any further foreign degree, etc., whatever. So there is some objective which is attached behind your decisions which you make, yes or no? Of course, yes. So similar to that, any particular CFO which will be involved in decision making of a company has some objective. And guys, the objective behind it is to maximize the wealth of equity shareholders. Okay. So whenever you are going to study financial management, always think that you are a CFO of a company. you are going to make decisions with an objective that you are going to maximize the wealth of equity shareholders. Okay. So always remember this, that every CFO of a company will only be involved in one thing, and that is maximizing the wealth of equity shareholders. Okay. And how do you think that the wealth of equity shareholders are going to be enhanced? How is it going to be maximized? Can I say that the wealth of equity shareholders can be maximized by increasing the market price of equity share of the company? Come on, yes or no? Of course, yes. So when we keep on increasing the market price of equity share, automatically the wealth of equity shareholder is going to enhance. So as a CFO of a company, your objective is very simple, that make decisions in such a way that equity share price of the company keeps on increasing and the wealth of equity shareholder is also going to be enhanced. Okay. So as we are discussing, students, entire subject of financial management, are we going to study from the company's perspective? Yes or no? Yes, sir. Second, are we going to make decisions? Yes or no? Yes, sir. Third, who are we in this entire subject of financial management? CFOs. And fourth, will the CFO make decision with an objective to maximize the wealth of equity shareholders? Come on, yes or no? Yes, sir. So these are the important things which you all should know before you study financial management. And guys, there are three types of decisions which a CFO is going to make. The first type of decision which any CFO makes is capital structure decisions, and that is nothing but how to raise capital. So the first type of decision what a CFO is going to make is, you know what, capital structure decisions, and that is how to finance a particular company. It's the first decision what a CFO is going to make. The second type of decision what a CFO is going to make will be where to invest your capital. And the third type of decision what a CFO is going to make is whether to distribute your dividends or not. So the entire subject of financial management is based on these three types of decisions. The first one is called as capital structure decisions, which deals with how to raise the capital. Because as you are aware that a company is going to raise the capital from different sources. Come on, yes or no? Yes, sir. A company is going to raise the capital from issue of equity shares, from issue of preference shares, from issue of debentures, by taking long-term loans from the banks. So these are the multiple sources from which the company is going to raise the capital. And once the capital is being raised, what is the next step? The next step is we are going to learn how to invest that particular capital. So can we invest the capital in different types of projects? Yes or no? Yes, sir. Can we invest that capital in different types of fixed assets? Yes or no? Yes, sir. Can we keep some amount by the way of working capital? Come on, yes or no? Of course, yes. So then we are going to learn how to invest your capital. If there is any surplus capital left, can we make investments by purchasing equity shares of some other companies? Of course, yes. So this entire subject, we are going to learn from the perspective that if the capital is being raised, where are we going to then invest that particular capital and generate some profits out of it? And once the profits have been generated, then comes the third step, the third decision making, and that is whether we should distribute our dividends or not. Now, of course, as you all are aware that equity dividend is not at all mandatory, right? It depends upon the CFO of a company whether they want to distribute the equity dividend or not. Now, if suppose the company wants to expand and grow, of course, the dividends will not be distributed. What will be done with that amount of the profits? That amount of the profits will be reinvested. That amount of the profits will be reinvested. And with that amount of the profits which is being reinvested, can the company expand and grow? Come on, yes or no? Of course, yes. And if the company thinks that we don't want this amount of the profits, rather let us distribute that by the way of the dividends. Then the company will distribute the equity dividends, the company will distribute their profits. So the third important decision making what a CFO has to make is your dividend decisions. That is whether to distribute your equity dividends or not. So overall, my dear students, what I want to try and explain you here is that in all, the entire subject of financial management, which deals with management of finance, we are going to do it from the company's perspective. Who does it? A CFO. Will he be involved in decision making? Yes. So this subject is all about making decisions for managing finance of a company. And as I told you earlier, that every decision will have some objective. The objective here is to maximize the wealth of equity shareholders. So my dear students, there are three types of decisions what a CFO has to make. The first type of decision is whether, what are the different sources from which we are going to raise the capital. So it's called as your capital structure decisions. The second type of decision is called as your investment decisions. And the third type of decision is called as your dividend decisions. How to raise the capital, where to invest the capital, and also from the capital, if there are any profits generated, whether we should distribute that or not. Okay. But always remember that make decisions in such a way that wealth of equity shareholders will increase. And that is how equity shareholders market price will enhance and the wealth will be increased and the entire objective of learning financial management will be achieved. Okay. So first let us write down a little bit of introduction about what we have discussed till now. Okay. So in introduction about financial management, we will write down we will learn how to manage finance of companies full stop continue. The CFO is involved in decision making process where the objective is to maximize the wealth of equity shareholders. And then you all can write down there are three steps. There are three types of decisions. So what is your first type of decision? It is called as your capital structure decisions. The second type is called as your investment decisions. And the third one is called as your dividend decisions. Okay. So when we are talking about capital structure decisions, it means that we are talking about how to raise the capital. Come on, yes or no? Yes, sir. So capital structure deals with how to raise capital. Then your investment decisions will deal with where to invest capital. And dividend decisions will deal with whether to distribute equity dividend or not. Whether to distribute equity dividend or not. Okay. So my dear students, this is the entire background about what financial management is all about. At inter-CA level, the entire financial management, we are going to study from this particular perspective, that we are managing finance of company as a CFO, getting involved in decision making with the objective of maximizing the wealth of equity shareholders. And there are three types of decision what a CFO needs to make. That is how to raise the capital, where to invest the capital, and whether we should distribute equity dividends or not. Okay. So this is the entire background. And you know what? The entire subject of financial management, all the chapters are actually based on these three decisions only. So we have chapters on how to raise the capital, which is called as your cost of capital and capital structure decisions. So this is nothing but how to raise the capital. Then we have chapters on where to invest the capital. So we have chapters called as ratio analysis, which will help you to understand that if you want to invest your surplus funds in equities of some other companies, then how should we carefully analyze the particular company? How should we analyze the ratios of that particular company and whether we should make investments or not? Then we are going to have chapters called as investment decisions, where we are going to learn how to analyze the projects of the particular company using discounted cash flow methods, IRR, etc., etc. And based on that, we will decide whether we should make investment in a particular project or not. Then we have something which is called as dividend distribution, so dividend policy decisions. So we have a chapter which is dedicated to dividend decisions entirely, that whether we should distribute your equity dividends or not. So the syllabus of entire this financial management inter-CA is so amazing that it takes into consideration each and every decision of a CFO, whether it is raising capital, investment of capital, or whether we should distribute equity dividend or not. Okay. So now, my dear students, now the background of financial management is over. Okay. So we will be now starting with our very first chapter. We are not going to waste much time here. Okay. So we will be starting with our first chapter, and that is nothing but your ratio analysis. Okay. So first, today we'll be discussing about what ratio analysis are, why is it important, and how many ratios we are going to study, what are the types of ratios. So if you are going to just listen to me very carefully for this particular lecture, your all the ratios with all the concepts will be covered in detail. Okay. So of course, it's going to be more and more of theory. Okay. So don't expect much entertainment in this particular part. But yes, make a note of whatever we are discussing very thoroughly. Okay. And then once these ratios, the fundamentals of all the ratios will be covered very thoroughly here, then it becomes very easy for us to practically solve the problems as well. Okay. So we are going to start with our very first chapter, and the name of the chapter is ratio analysis. Okay. So first of all, this is your base foundation of all the other remaining chapters when we are going to deal with your financial management. Okay. So ratio analysis concepts will be used in chapters of leverages, cost of capital also, some part in capital structure also. Okay. So whatever we are going to learn here, it's going to be applicable for other chapters as well. Okay. See, first of all, guys, why do we need a ratio? Okay. Why is ratio important? So very simple concept, that if I give you two companies, okay, let's say for example, I tell you there is a company, Reliance Industries Limited, and let's say Bhavin Industries Limited. Okay. So these are the two companies which we have. And suppose I tell you that sales of Reliance Industries Limited is, example, 1000 crores, and sales of Bhavin Industries Limited is 100 crores. Okay. Based on just this particular part, okay, that we have sales of Reliance of 1000 crores and sales of Bhavin Industries Limited as your 100 crores. If suppose I just give you this data, and if I tell you that which company is performing better, can you make a judgment just on the basis of sales? Then the answer is absolutely no. So we just can't decide on the basis of sales that which company is performing better. Don't you think that we need some ratio for adequate analysis? Yes or no? Of course, yes. Now let's say, for example, if I give you profits figures, suppose my profits of Reliance Industries Limited is example 100 crores, and suppose Bhavan Industries Limited has a profit of 50 crores. Now in this particular case, can we say that the profit ratio of BIL is much higher as compared to RIL? Come on, yes or no? Of course, yes. And now we have the basis of judgment where we can say that BIL is performing better than RIL, at least in the example. Okay. So are we performing better than Reliance Industries Limited? Come on, yes or no? Of course, yes. Why? Because your profit ratio is relatively higher. Your profit ratio here is just 10% and the profit ratio here is 50%. So on the basis of 100 crore sales, if I'm able to generate a profits of 50 crores, so my efficiency, my performance is better to the other companies. Come on, yes or no? Of course, yes. So a ratio is a relationship. It's a nexus between two or more variables to give some meaningful result. Because only standalone figures cannot give you any meaningful result. If I just check sales and just compare only two isolated figures, is it going to give me any meaningful result? The answer is absolutely no. There has to be a ratio. There has to be a relationship of two or more variables. Only then we can generate a meaningful result. So that's why, my dear students, ratio is very important if you want to evaluate the performance of any particular company. And if you are a CFO of your own company, you should know that how my particular company is performing based on quarter basis, on previous year data basis. So for that, we should definitely learn ratio analysis. Okay. So from this example, at least it is evident that single figures cannot give you any meaningful result. So hence, we should develop a relationship between two or more variables. Come on, yes or no? Yes, and a ratio can be created. So you all can just write down these small important points along with me. Of course, the notes for this will be there in the description. So you all can download it from there. And if you have liked the video till now, keep on pressing the like button and also comment and chat with me as well. Okay. So you all can just write down here. Ratio is a relationship between two or more variables to achieve meaningful result. So ratio is a relationship between two or more variables to achieve meaningful result. There are three main types of ratios. So students, how many types of ratios are there? There are three main types of ratios. Okay. So the first type of a ratio which we have is called as balance sheet ratios. The second one is called as P&L ratios, and the third one is called as your mixed ratios. So in all, you will be studying somewhere around 37 to 40 ratios in this entire chapter. Okay. But this 37 to 40 ratios, I have classified into three main types of ratios, and then there are some other important ratios as well. But these three main types of ratios are, the first one is called as your balance sheet ratios. Okay. So you all can just make a note of this. First one is called as your balance sheet ratios. So keep on preparing the notes along with me. Very important, whether you're watching this as a recorded or as a live batch, because if you keep on making notes, you'll be understanding that what are the different concepts which are being used, and also at the same time you'll not be bored as well. Okay, so keep on writing down and make the notes along with me. Don't wait for the notes to be uploaded and then copy it down, because then the backlog will be too much. Okay, so we have balance sheet ratios, then we have something which is called as P&L ratios, and then we have mixed ratios. So when we talk about balance sheet ratios, of course, why do we call it as a balance sheet ratio is because your numerator and the denominator, okay, both will come from the balance sheet. Come on, yes or no? Yes, sir. Your numerator, your denominator, both is going to come from your balance sheet. So that's why we call it as a balance sheet ratio. And why do we call as a P&L ratio? Because your numerator will be there in P&L, your denominator will be there in P&L. So that's why we call it as a P&L ratio. And mixed ratios, you might have guessed it right. In mixed ratios, your numerator will come from P&L and your denominator will come from your balance sheet. So that is why we call this as your mixed ratio. Okay. So my dear students, how many main types of ratios do we have? We have three main types of ratios. The first one, we call it as a balance sheet ratio, where the numerator and denominator both will come from your balance sheet. Second one, we call it as a P&L ratio, where your numerator and denominator both will come from your P&L. And the third one is your mixed ratio, where your numerator will come from P&L and your denominator will come from your balance sheet. So these are your three main sets of ratios. And my dear students, whenever we talk about balance sheet ratios, we are also talking about the solvency ratio. We are talking about what, beta? We are talking about solvency ratios. So balance sheet ratios are also known as solvency ratios. Why we call this as a solvency ratio? Because whenever we check the balance sheet of a particular company, what are we checking? We are checking the liabilities and the assets of the companies. And when we are checking the liabilities and the assets of the companies, we are checking their own financial position. So checking the financial position means what? We are checking what is going to be the solvency position of a particular company. So always remember, my dear students, that whenever in the question, if they ask you that, check the solvency position of a company. So how do we check the solvency position of a company? We check the solvency position by checking its assets and liabilities. Okay, by checking its what? Assets and liabilities. So balance sheet ratios, we also call it as your solvency ratios. Okay. Then P&L ratios, can I say P&L ratios will be called as your performance ratios, because whenever we are calculating the P&L ratio for a particular company, what are we actually checking? We are checking how well the particular company is performing. What is going to be the gross profit? What is going to be the net profit, etc., etc. So performance is something which we determine with the help of your P&L ratios. And then guys, in mixed ratio, there are two main sets of mixed ratios, where we call it as your turnover ratios, and then there is something which is called as your return ratios. So we have turnover ratios and we have return ratios when we'll be discussing your mixed ratios. Okay, so these are the two categories in your mixed ratios. So the first set is called as your balance sheet ratio. So let us now start with that. The first set of ratios, balance sheet ratios. Okay, now let us discuss about this. So as I just told you that balance sheet ratios actually have numerator figures are going to come from your balance sheet and denominators figures are going to come from your balance sheet. And the objective is to check what is going to be the solvency of a particular company. Yes or no? Yes, sir. Okay. So, my dear students, the first very most basic important and something, you know, which is which you'll find it in almost every question is your current ratio. Okay, so the first ratio which we are going to study in your balance sheet ratio is your current ratio. Now, I think you must be aware about what a current ratio is. Current ratio is something where we compare your current assets and your current liabilities. So whenever we are comparing current assets and current liabilities, what do we actually get? We get your current ratio. So what are current assets? Current assets are actually those assets which can be converted into cash within a period of 1 year. So those assets are actually called as your current assets. And current liabilities are those liabilities which can be repaid within a period of 1 year. Okay. So very clear. What are current assets and current liabilities? Current assets are actually those assets which can be converted into cash within a period of 1 year. Okay. So what are the examples of that? Okay. Can I say stock, debtors, bills receivables, prepaid expenses, cash, bank, etc. All these can be immediately converted into cash within a period of 1 year. Come on, yes or no? Yes, sir. So current assets are those assets which can be liquidated within a period of 1 year, and current liabilities are those liabilities which can be repaid within the period of 1 year. Okay. So you all can just first write down this. Current assets can be converted in cash within 1 year, and current liabilities can be paid, rather can be repaid within 1 year. Okay. So what are the examples we have? We have current assets examples like stock, then we have debtors, then we have bills receivables, then we have prepaid expenses, then we have cash, we have bank. All these are some of the basic examples of your current assets. Come on, yes or no? Yes, sir. And then to this, we divide it by your current liabilities. So what are your current liabilities? We have something which is called as your creditors. Then we have outstanding expenses, right? Then also at the same time, we have bills payables. Are those your current liabilities? Come on, yes or no? Yes, sir. So in this particular ratio, we are actually checking what is going to be the short-term solvency position of a particular company. So what are we checking? We are actually checking short-term solvency position. Short-term solvency position. So we are actually going to check what is going to be your short-term solvency position of a particular company. So we are comparing definitely current assets and current liabilities, and this current assets and current liabilities actually help you to understand that what is going to be your short-term solvency position of a particular company. See, let's say for example, if I have stock with me, now whatever is going to be my amount of stock, or whatever is going to be the stock which is lying in my godown, or if it's there in the form of raw material or work in progress or finished goods, don't you think that it can be either consumed or processed or used or sold within a period of 1 year? Come on, yes or no? Of course, yes. So stock is something which can be easily liquidated within a period of 1 year. Debtors, we never give debtors a credit period of more than a year. We never tell our debtors that please give us the payment after 15 months, 18 months, 20 months. So debtors, we always offer them a credit period of 6 months, 3 months, 2 months, 1 month, 15 days, 5 days, some 10 days, etc. So all these are your assets which can be converted into cash within a period of 1 year. Bills receivable, same thing, prepaid expenses, cash, bank. Also, whenever we are going to buy the goods, can I say creditors, outstanding expenses, bills payable, everything can be repaid within a period of 1 year. Come on, yes or no? Of course, yes. So guys, whenever we are comparing these current assets and current liabilities, we are definitely checking the solvency position. But the solvency position which we are checking is your short-term solvency position, not long-term, short-term solvency position. So if the company is short-term insolvent, then the problems have started arising and the company needs to arrange the funds so that it can come out of this problem as fast as possible. So that is why, as an analyst, as a CFO of a company, you should always keep a proper trace on your current ratio. Here we are comparing your current assets and your current liabilities. Here we are comparing that how your short-term current assets are sufficient to meet your short-term current liabilities. And my dear students, the standard ratio for this is 2:1. For every 1 rupee of current liability, we have double current assets. We have twice the current assets. So the standard ratio for this particular ratio is what? 2:1. So as a CFO of a company, always remember like this, that whenever we are going to deal with your current ratio, we are going to check that for every 1 rupee of current liability, how many current assets do I have? And of course, it should be more. The asset should always be more than liability for being more solvent. But the standard ratio for this is what? It is nothing but 2:1. So always try and maintain this standard ratio even in your company. And when you are going to make investment in some other companies and you are going to check the current ratio, just see to it that the standard ratio for this current ratio is 2:1 or nearest to that. But guys, institute tells us that this ratio should always and always be higher the better, higher the better. So what does this ratio tells you? Higher the current ratio, better it is. Okay. So current ratio being higher the better, is it better? Yes. You should always have more assets as compared to liabilities. But this particular analysis has some problem. And the problem is, if you keep on keeping your current ratio as high as possible, it results in inefficiency in the particular company. What does it result into? It results in inefficiency. So my dear students, if this ratio is extremely high, can I say that there is going to be inefficiency in the company? Come on, yes or no? Then the answer is yes, sir. So you should try and maintain as high as possible, but keep it up to the extent of standard ratio, which is 2:1. But if you keep it more than 2:1, if you keep the current ratio of a company as 5:1, then what does it mean? That there are too many current assets for 1 rupee of current liability. You have blocked your money in too much of your current assets, which signifies inefficiencies. Okay, my dear students. So always remember that this ratio should always be higher the better, but keep it up to the extent of standard ratio. If this ratio is extremely high, then what does it mean? If this ratio is extremely high, then what does it mean? It means inefficiency in utilization of funds. And guys, if this ratio is low, okay, then what does it indicate? It indicates there is insolvency. There is insolvency. But this insolvency is always short-term in nature. Okay, this insolvency is short-term in nature. So my dear students, your very first ratio, which is your current ratio, is now completed. So current ratio actually has your current assets upon your current liabilities. What are current assets? The assets which can be converted into cash within the period of 1 year. Okay. What are your current liabilities? The liabilities which can be repaid within the period of 1 year. So those are actually called as your current liabilities. Yes or no? Yes, sir. Now, my dear students, do we have a standard ratio for the same? Yes, sir. The standard ratio for the same is nothing but 2:1, which indicates for every 1 rupee of current liability, we are going to have 2 rupees of current assets available with us. And these are some of the examples of your current assets and current liabilities, and this signifies your short-term solvency position. This ratio in examination should always be higher the better. Okay. But guys, if this ratio is extremely high, it indicates inefficiency in utilization of funds. Okay. In examination, if suppose there are two companies available with you, RIL and BIL. RIL has a current ratio of 3:1. BIL has a current ratio of 6:1. In examination, which company will you select? You will select BIL only. because the ratio is higher. It means that the short-term solvency is very strong, but with a note. And what is that note? The note is, if this ratio becomes 6:1, it means that the management is somehow keeping more amount in the form of current assets. It's keeping more amount in the form of stock, debtors, bill receivable, cash, bank, and all this signifies inefficiency in utilization of funds. So always try to maintain the standard ratio of 2:1. Okay. And guys, if this ratio is extremely low, what does it signify? It signifies insolvency. So I hope you all have understood this much part. Okay, your first ratio, and current ratio, what does it intends to check? Short-term solvency position. Okay, then we are going to start with your second ratio. And guys, the second ratio which we have is called as your quick ratio. Okay, so very quickly we will discuss now what is quick ratio. Quick ratio signifies that what is going to be your immediate solvency position. So your current ratio was signifying short-term solvency position. Your quick ratio is going to signify your immediate solvency position. Okay, immediate solvency position. So quick ratio takes into consideration your quick assets, which we are going to divide by quick liabilities. Now you are like, sir, what a wonderful ratio, quick assets upon quick liabilities. But can you please elaborate what are your quick assets and what are your quick liabilities? So quick assets actually are those assets which can be immediately converted into cash without loss of time or value. So there should be no loss of time or value. Okay. So first we'll write down what are your quick assets. Okay. And I want this particular part to be in your notebooks. Okay. So what are your quick assets? So quick assets are those assets which can be immediately converted into cash without loss of time or value. Okay, so we have to convert this immediately into cash, but there should be no loss of time or value. Now, my dear students, first of all, let us understand this very thoroughly. What are quick assets? Okay, let's talk about quick assets. All the types of current assets are your quick assets, except for two. And that is nothing but stock and prepaid expenses. Because stock and prepaid expenses cannot be immediately converted into cash. If we convert that into cash, there is going to be loss of time and there is going to be loss of value. Okay. So what does this particular quick assets tell you? Okay. It tells you that all current assets are your quick assets except for two. That is stock and prepaid expenses. So stock and prepaid expenses. Are these two your non-quick assets by nature? Come on, yes or no? Yes, sir. So stock and prepaid expenses are your non-quick assets. Because if we want to convert that into cash, then there will be either loss of time or there will be loss of value. That's why we treat stock and prepaid expenses as your non-quick assets. Okay. But apart from that, all the current assets are your quick assets, yes or no? Yes, sir. So debtors, is it your quick asset? Yes. Cash, is it your quick asset? Yes. Bank, quick asset? Yes. Bill receivable, quick asset? Yes. But stock and prepaid expenses, both of them are your non-quick asset, because if you want to convert that into cash, there can be either loss of time or value. Okay. And what are your quick liabilities? Then, my dear students, all your current liabilities are your quick liabilities. So all your current liabilities, can you immediately repay it if you want to? Yes or no? Yes, sir. Okay. But there is one exception to it, that is bank overdraft. But ICAI doesn't consider it. ICAI considers bank overdraft also as your quick liability only. So that's why there is no exclusion from the current liability. All your current liabilities are actually your quick liabilities. Okay. But yes, there is an exception, and that is bank overdraft. It can be treated as your non-quick liabilities, but for the time being, we are not going to discuss that. We are going to understand all your current liabilities are quick in nature. It can be immediately repaid. Okay. So first of all, in your quick ratio, what are we checking? That how many quick assets do we have to repay your quick liabilities? So are we comparing the solvency position? Yes or no? Yes, sir. Are we comparing the immediate solvency position? Come on, yes or no? Yes, sir. Because we want to convert, we want to liquidate that into cash immediately without loss of time or value. See here, as you guys can just check, that current assets and current liabilities were those assets and liabilities which were getting converted into cash, but within the period of 1 year. So it was taking 1 year time. But is the quick ratio going to take 1 year time? No. We are talking about getting it converted immediately without loss of time or value. So that's why, my dear students, stock and prepaid expenses, both of them are treated as your non-quick assets. Because if you want to immediately convert that into cash, there will be definitely some loss of time and there is going to be loss of value. Okay. So my dear students, let's talk about why is stock and prepaid expenses treated as non-quick assets? Why are they treated as non-quick assets? So let us discuss this. See guys, whenever we are converting stock into cash, there can be either loss of time or there will be either loss of value. Why? See, understand like this. Suppose, my dear students, suppose stock of 100 phones, okay, available with you. You want to get rid of that stock immediately and get it converted into cash. Then the next thing which comes to your mind to adopt this particular strategy, what are you going to do? Can I say that we are going to start with stock clearance sales? Right? What are stock clearance sales? Stock clearance sales are when we are going to sell this particular stock at a discount because we want to get rid of that particular stock. We want to convert that into stock. So don't you think that there is some loss of value involved here? Come on, yes or no? Of course, yes, there is definitely loss of value. Why is there a loss of value? Because this stock can be liquidated and it can be converted into cash, but it is only and only possible if you are going to give them some discount, if there is going to be some loss in. So that's why stock is treated as your non-quick asset. Because if you want to convert it into cash, reduce its value immediately, or else wait for 3 months, 4 months for that stock to be converted into cash. So there is loss of time involved there. Similarly, my dear students, prepaid expenses that cannot be converted into cash immediately. How can prepaid expenses be converted into cash? It's not at all possible. Prepaid expenses cannot be converted into cash. Why I'm telling you this is because prepaid expenses, once you make the payment, that particular prepaid expenses is definitely going to be there. You have made the payment, those particular prepaid expenses, you have to either utilize the services, you cannot liquidate it, and if you want to liquidate it, is there going to be loss in value? Come on, yes or no? Yes, sir. There is going to be loss in. So, my dear students, prepaid expenses, you cannot immediately convert that into cash. There will be loss in value that as well. So, the whole point is that stock, prepaid expenses, both are your non-quick assets. Because if you want to convert that into cash, there will be either loss in time or there will be loss in value. But apart from that, debtors, then bills receivable, all these things, my dear students, are going to be your quick assets. So now you must be wondering, yes, sir, in case of debtors also, there is a possibility that if I want to immediately convert that particular debtors into cash, I might have to offer some discount to my customer. So let's say, for example, let's say I have given 2 months credit to my customer. Okay. And my customer needs to give me the payment after the end of 2 months. but I want the money right now. Okay. So let's say, for example, usually, when I make cash sales, of course, I sell the goods at 100 rupees. But when I make credit sales, of course, I will add the cost of carrying to that particular debtors. Come on, yes or no? Yes, sir, because my money is now not received immediately. My money is received after 2 months. So definitely those particular goods, which I'm going to sell it to my customer, I will sell it at, let's say, at 105 rupees. Why? Because that 5 rupees is nothing but that interest cost which I'm bearing because I'm receiving the money after the end of 2 months. So that is why whenever you are also going to buy the goods from any particular shop, store, etc., if you're buying it on cash basis, you will find it cheaper. But if you're going to buy it on credit basis, you'll find it little bit expensive. Why? Because that seller has included some cost of carrying that particular debtors. Come on, yes or no? Yes, sir. Because that customer is not giving you the payment right now. That customer is going to give you the payment after some period of time. So in that particular case, are we going to add some interest cost to it? Yes or no? Yes, sir. So my dear students, this 105 I was supposed to receive after 2 months. So my debtors were worth rupees 105. But I want the money right now. So I will go to my customer and tell my customer, listen, I want the money right now. Will you give me the money? If the customer has funds, he will tell you, yes, how much discount are you offering? So I'll tell him, listen, I'll give you cash discount of 5 rupees. So then I'll be receiving 100 rupees from that particular customer. So don't you think that even if suppose I was selling the goods on cash basis, I was receiving 100. Now even after giving cash discount, I'm going to receive that 100 rupees itself. There is no loss of value involved when the customers give you the payment immediately. So this is something you'll have to understand. There is no loss of value which is getting involved. So my dear students, always remember that whenever we are going to offer some cash discount, it takes care of the time value of money. And that's why cash discount is always determined also on the basis of time value only. Cash discount percentage is going to be 2%, 4%, 3%, 5%. It can never be flat 50% off, as the case which is there in case of stock. So now guys, pay attention. When we are giving stock clearance sale, are we offering them 10%, 50%, 60% discount? Come on, yes or no? Yes, sir. We are offering them 60% discount, 50% discount so that our stock goes away. So definitely there is going to be loss of value there. But there is not going to be any loss of value when we are going to deal with customers giving us payment by we offering them cash discount. Because that cash discount percentage is never going to be 50% or 60%. It's just going to compensate your time value of money. So that is why, my dear students, I hope it's very clear that whenever we are also having bills receivable and we want to immediately convert that into cash, and with that particular bill receivables, if we go to our bank and if they discount it and give it to us, that discount charges are just 2%, 3%, 4%, 5%. You have never seen discount as flat 50% off. Whenever you go for bill receivable discounting, never ever they give you 50% off. I hope you guys are trying to understand. They will always give you 2%, 3% because it is compensating for your time value of money. So there is no loss of value which is being involved there. So conceptually, I hope it is now very much clear that from your current assets, we are just going to subtract only two types of non-quick assets, that is stock and your prepaid expenses. Debtors and all those things, bill receivables, they all are to be treated as your quick assets only. I hope you are finding this interesting. This debtors bill receivable logic, you're not going to get there even in institute study module. But conceptually, we are going to learn it in this particular way. If you like it, please like this particular video. Also comment while watching also. Even if you are watching this as recorded, please like it. Okay. Now, my dear students, as I told you that the objective of this particular ratio is what? The objective of your quick ratio is to check immediate solvency position. So my dear students, if in the examination they will ask you calculate short-term solvency position, then they are asking you about current ratio. If they ask you calculate immediate solvency position, then they are actually asking you about your quick ratio. So this is something which you have to understand. Huh? Okay, so this is the bifurcation. This is the when we are talking about your immediate solvency position, we are only talking about quick ratio. If we are talking about short-term solvency position, we are talking about your current ratio. Okay, so this is the bifurcation. This is the distinguish between the two. Current ratio, everything gets converted immediately. No, everything gets converted within a period of 1 year. Quick ratio, everything gets converted immediately without loss of time or okay. Only if they give it to you in the examination that bank overdraft is to be treated as your non-quick liability only, then we need to subtract it, or else there is no need to subtract the same. Okay, so we are not going to subtract the bank overdraft until unless they specify. Okay, only if they tell you it's a non-quick liability, then we need to subtract it, or else all the types of bank overdrafts are to be treated as quick in nature. Fine. So what should be the standard ratio for quick ratio? As there was standard ratio for your current ratio, that as a CFO of a company, now you are aware about the fact that how much current ratio you have to keep. You have to keep 2:1 for every 1 rupee of liability, 2 rupees of your current assets. So my dear students, similarly, there is a standard ratio for quick ratio as well. And the standard ratio for quick ratio is 1:1. So it means that for every 1 rupee of quick liability, we should have 1 rupee of quick assets. Okay. So this is something which you have to maintain. Of course, in the examination, again, this ratio will be higher the better. So you'll always invest in a company where the quick ratio is going to be as high as possible. But there is a twist. As I've told you earlier also, if this ratio is extremely high, does it indicate inefficiency? Come on, yes or no? Yes, sir. And if this ratio is extremely low, it indicates insolvency. So you should not be satisfied and happy if this ratio is 5:1. It indicates inefficiency. Okay. So with this, my dear students, your second ratio is also done. Okay. First ratio we discussed was your current ratio. Second ratio which we discussed was your quick ratio. Then we have something which is called as your super quick ratio. Okay. So now we are discussing super quick ratio. So what is now super quick ratio? So guys, super quick ratio actually indicates how much liquidity which you have to repay 1 rupee of current liability. So there is no need for any conversion in this particular. This ratio only and only tells you that what is the liquidity which you have it with you right now to repay 1 rupee of current liability. So super quick ratio actually deals with what? It deals with how much funds we have right now to repay 1 rupee of current liability. 1 rupee of current liability. So we don't have to actually wait for the process of conversion. Rather, what are we going to do? We are going to check that what is the liquidity, what is the absolute liquidity which is available to repay 1 rupee of current liability. Okay. So super quick ratio does not deal with any kinds of conversions. Super quick ratio only deals with how much funds do we readily have. Okay. So here we are talking about cash and cash equivalents. How much cash and near to cash available we have for repaying 1 rupee of current liability. So in this particular case, we have something which is called as your cash plus bank plus any kind of marketable securities. So guys, are marketable securities also to be treated as your super quick assets? Come on, yes or no? Yes, sir. Because marketable securities are those securities which you can immediately sell it in the market, and within 2 days you will be getting the funds in your account. Now though, you don't even have to wait for 2 days. For stocks, etc., it's okay. But if you're dealing with derivatives, If you close your position today itself, then you can withdraw the money tomorrow as well. So it is like all these marketable securities are what? Can they be immediately converted into cash? Are they in the form of liquidity only? Come on, yes or no? Then the answer is yes. So that's why cash, bank and marketable securities are itself called as your super quick assets. And we need to check that what is the amount of super quick assets we have to repay 1 rupee of current liability. Current liability. So to pay 1 rupee of current liability, what is your super quick assets which you have? Okay. So there is no standard ratio for the same. Okay. But if this ratio is extremely high, what does it indicate? There is inefficiency. Our equity shareholders have not given you money so that you keep it in the form of cash, bank and marketable securities. They have given you the money. Why? So that you can invest in projects and working capital and then grow the businesses. So that is why, my dear students, if the super quick ratio is extremely high, what does it tell you? It tells you inefficiency. And if this ratio is extremely low, what does it tells you? That there can be possibility of insolvency, or there can be possibility where we have to now redeem other types of current assets so that it can be converted into cash, and that cash we can use to repay 1 rupee of current liability. Okay. So how much funds we have right now? So there is no need for any conversion. Okay. So that's why this ratio is also called as your absolute liquidity ratio. And it's also called as your cash reservoir ratio. All these things means the same. How much is the cash reserve which you have to keep to meet your 1 rupee of current liability? Okay. If this ratio is extremely high, what does it indicate? It indicates inefficiency. Okay. So high means inefficiency. Okay. In utilization of funds. And if this ratio is low, then there is insolvency. Okay. Then there is insolvency. So your first three ratios are over. What are your first three ratios? The first ratio is your current ratio, where we are going to have current assets and divide that by current liabilities. The second ratio which we actually have is called as your quick ratio, where we are going to check from current assets, subtract stock and prepaid expenses, and we are going to divide that by current liabilities. Then, my dear students, we have something which is called as your super quick ratio, where we are going to check what is the cash and cash equivalent which we have it right now to repay our 1 rupee of current liability. So that is called as your super quick ratio. Okay. So we have these ratios for which we have current ratio, standard ratio is 2:1. Then we have quick ratio, standard ratio is 1:1. And then we have the super quick ratio for which there is no standard ratio which is available. Okay. I hope you have understood this much. But all these three ratios, guys, in the examination should always be lower the better, or it should be higher the better. It should always and always be higher the better. All the three ratios, they should always be higher the better in the examination. Okay, guys. Chalo. Now continuing further. We have now something which is called as your fourth ratio, and this fourth ratio is called as your stock to working capital ratio. What is this ratio called as? Stock to working capital ratio. Okay. Now listen to this very carefully. Stock to working capital ratio. Now, in stock to working capital ratio, we need to check that what is the amount of stock which you have in the working capital of the company. Or else we can also put it like this, that what is the amount of working capital which is blocked in the form of stock. Okay. See, for example, if you are starting your business with 1 lakh rupees, okay, and with this 1 lakh rupees, you have purchased some fixed assets of 80,000. So you have kept some cash available with you, that is 20,000. So can I say cash forms part of your current asset? So this is nothing but the amount of working capital which you have, which you are going to utilize it for the smooth functioning. Okay. Now, my dear students, this cash which you have 20,000, with this amount of the cash, let's say for example, I'm buying some stock. Now guys, if I'm buying some stock, then can I say this cash gets converted in the form of the stock? Come on, yes or no? Yes, sir. And this stock is also part of your current assets. So my working capital formula is current assets minus current liability. So in my current assets, I have stock of 20,000. There is no current liability. This working capital amount is 20,000. So what is my stock to working capital? So amount of the stock which I had is 20,000. Amount of the working capital which I have is 20,000. Can I say this ratio is nothing but 1:1? So this indicates that for every 1 rupee of working capital we have, exact 100% blocked in the form of stock. But guys, if this ratio is 1:1, it indicates that the liquidity in the company is 0. Can I say there is no liquidity at all? Come on, yes or no? Yes, sir. Why? Because that 1 rupee of working capital which you had, what did you do with that working capital? You have blocked it in the form of stock. So you have not kept even a single rupee by the way of liquidity. And this is actually not correct. Because now if tomorrow you want to make any payment of electricity bill or staff salary, then you don't have the liquidity available with you. How will you make this kind of payments? Are we going to give them stock? Then the answer is no. So what I'm trying to make you understand is, if this particular ratio is very high, it means that the liquidity of the company is lower. Okay. So higher the stock to working capital ratio, can I say that lower is going to be the liquidity? Come on, yes or no? Then the answer is yes. Your liquidity is going to be lower. Higher the stock to working capital ratio, lower is going to be your liquidity. Okay. So what is the formula for stock to working capital ratio? So here we are just going to take into consideration your closing stock, and we'll be dividing that by your working capital. Okay. And what is actually your working capital? Your working capital is current assets minus current liability. This will give you your working capital. Current assets minus current liabilities. So stock to working capital ratio is nothing but CA minus your closing stock upon your working capital, and your working capital is CA minus CL. So 1 rupee of working capital, we need to check what is the amount which is blocked in the form of your stock. Okay. Now, my dear students, understand like this. Suppose your stock is 80,000 and your working capital is 1. Then this ratio is what? 0.8:1. What does it indicate? That for 1 rupee of working capital, we have 80% which is blocked in the form of stock. With that 1 rupee of working capital, we have 80% which is blocked in the form of stock. So can I say balance 20% is liquidity? That can be in the form of your debtors or anything else as well. It's absolutely fine. But can I say that will be part of your liquidity? Come on, yes or no? Yes, sir. So with this particular ratio, we can judge that how much money the company is blocking in the form of stock and how much money they're keeping it for liquidity. If this ratio is extremely high, then it is very dangerous also. Huh? Why is it dangerous? Because now so much of your money is blocked in the form of stock. So if you want to liquidate it also, don't you think that it will take time? Because stock is a non-current assets. So how are you going to actually meet your expenses? Then it's not possible. So that's with this particular ratio, we are not going to keep extremely high in real life. And we are not going to keep it low as well. Because if we keep it extremely low, then we are not stocking ourselves. We are not keeping adequate stock. So that's also actually not a good thing. Okay, my dear students. So that's why we will have closing stock upon working capital. Unfortunately, there is no standard ratio for the same because it depends upon types of businesses, what you are doing. Okay. So this is closing stock upon working capital. In examination, what are you going to do? In examination, we cannot say higher the stock to working capital, better it is. So we just have to comment like this. If this ratio is very high, it means that the liquidity is lower and so on. Okay. So this is nothing but your fourth ratio which you have. So I hope you all have understood these four ratios. The first ratio is nothing but your current ratio. Second ratio is your quick ratio. Third is your super quick ratio. And fourth is your stock to working capital ratio. Now, my dear students, let us talk about the fifth ratio. The fifth ratio which we have is also a very important ratio called as your debt equity ratio. Okay. So here in this particular debt equity ratio, by the word debt, we actually mean your long-term funds, and your word equity actually means your shareholder funds. No, I'll put it like this: equity shareholder funds. Equity shareholders funds. Okay. Because this equity actually has different types of meanings based on, how do you analyze it? Sometimes this equity is only and only nothing but your shareholders funds, and sometimes this is nothing but your equity shareholders funds. So it depends upon, companies to it depends upon how we are analyzing and interpreting it, but we will follow ICAI view. And ICAI considers your equity as your equity shareholders funds for your ratio analysis part. Okay. So equity here means what? It means your equity shareholders funds. So what do we first of all mean by long-term funds? Can I say when we are issuing debentures? So these debentures, we always issue it from the perspective of more than 1 year, 2 years, 3 years, etc. So these are your long-term sources. So automatically debentures becomes what? It becomes your long-term funds and it becomes part of your debt. Also, when you are taking loan from the bank, you are going to repay it. Let's say after 3 years, 4 years, etc. Then that is called as your long-term loans. That is going to be forming part of your debt. But my dear students, thank you so much. But my dear students, also at the same time, if I tell you that if we are going to only and only deal with bank overdraft and all those things, short-term loans, will that be forming part of your debt? Answer is absolutely no. So debt actually means your long-term funds where the repayment is going to be for a period of more than a year, and your equity actually means your equity shareholder funds. So your equity shareholder funds deals with what? It deals with your equity share capital plus your reserves and surplus, and to this we'll be subtracting miscellaneous expenditure not written off. Miscellaneous expenditure not written off. So this is nothing but your meaning of equity shareholder funds. Okay. So equity share capital plus reserves and surplus minus miscellaneous expenditure not written off. Now guys, isn't this obvious that in this balance sheet, we'll be having equity share capital, let's say 1 lakh. Then we have reserves and surplus of, let's say, 50,000. Guys, reserves and surplus actually belongs to whom? Can I say it belongs to the true owners of the company? And who are the true owners of the company? Equity shareholders, they are the true owners of the company. So will the reserves and surplus be forming part of your equity shareholders funds? Come on, yes or no? Answer is absolutely yes. So reserves and surplus forms part of your equity shareholders funds. Let's say companies, they have not distributed that profits. Where this profits element will go? Can I say these profits are actually going to go to your equity shareholders funds only? Come on, yes or no? Yes, if the profits are not distributed, then it will be forming part of your equity shareholders funds. Also at the same time, any kind of revenue reserve, capital reserve, general reserve, will all that be forming part of your reserves and surplus? Come on, yes or no? Yes, sir. And this reserves and surplus belongs to whom? It belongs to equity shareholders of the company. So whenever we are talking about equity shareholders funds, reserves and surplus should be forming part of it. But any kind of miscellaneous expenditure not written off, we have to eliminate that. So what is your miscellaneous expenditure not written off? Can I say any kind of preliminary expenses? Are your preliminary expenses also part of miscellaneous expenditure not written off? Yes or no? Yes. Understand a concept like this. Let's say I have incorporated a company and incurred, let's say, 50,000 rupees as preliminary expenses. These are expenses actually to make article of association, memorandum of association, appointing CS, etc. whatever. Okay. So I have incurred 50,000 rupees. Now this 50,000 rupees which I have incurred, I cannot debit in my P&L account in the very first year. So what do I have to do with this 50,000? Then I have to amortize it. I have to write it over the period of, let's say, next 5 years. So when I have to write it off over the period of next 5 years, can I say every year my P&L account will be debited by 10,000 rupees? Come on, yes or no? Yes, sir. So every year it will be debited by 10,000, 10,000, 10,000 for the period of 5 years. So what is going to be the unamortized part? So if I'm debiting 50,000, may say 10,000 if I'm debiting it the first very year, so 40,000 is my unamortized part. But this unamortized part, will it be debited in future? Come on, yes or no? Of course, yes. And when it will be debited in the future, will it be reduced from the profits of the company? Come on, yes or no? Yes, sir. So whenever we are dealing with equity shareholder funds, in that equity shareholder funds, are we going to subtract your miscellaneous expenditure not written off? Come on, yes or no? Yes, sir. Why? Because that will be written off in future. And when that will be written off in future, will the equity shareholders funds going to come down? Come on, yes or no? Yes, because the profits are going to be reduced. So always remember like this. Whenever I talk about equity shareholder funds, search for such kind of, you have to search for such kind of not written off expenses which will be written off in future, that will reduce your equity shareholders amount. So your equity shareholders funds will be equity share capital plus reserves and surplus minus your miscellaneous expenditure not written off. And if I can give you more examples for the same, then any kind of, let's say, issue expenses not written off, will this be also considered as a part of miscellaneous expenditure not written off? Come on, yes or no? Yes, sir. Will it be written off in future? Yes, sir. So will it be reduced from your equity shareholders funds? Of course, yes. So whatever is your equity shareholders funds, from that we are going to subtract it. Also, my dear students, if there is any kind of preliminary expenses, as I told you, not written off, that needs to be subtracted. Any discount on issue, that is also amortized over the number of years. So that should also be subtracted, whatever is the not written off part. Also at the same time, if there is any commission which is amortized over the number of years, underwriting commission example. So which is to be amortized over the number of years. So if it is unamortized part, will it be written off in future? Yes, sir. So we have to subtract it. Okay. So all these things are going to play a very, 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 very important role in determining your equity shareholders funds. Okay. So your debt equity ratio actually is nothing but your long-term debt. This is the formula upon equity shareholders funds. Okay. If this ratio is lower, what does it indicate? That we are now not taking more debt in our capital structure. If this ratio is higher, what does it indicate? That we are taking some debt in the capital structure. Okay, it means that we are raising the funds from equity shareholders also, and we are raising the funds from debentures, debt, etc. also. Okay, guys, this particular ratio has a standard ratio, and the standard ratio for this is 2:1. So What does institute tells you that for every 1 rupee of your equity shareholders funds, keep twice as your long-term loans. Keep twice as your long-term debt, not more. If someone interprets this particular ratio as 200 is to 1, then what will happen? That they will take so much amount of debt and only 1 rupee of equity shareholders funds. It indicates that the risk in the company is extremely high. So we don't want, we want this ratio to be in real life as low as possible. But still, if you want to take debt, then the standard ratio is 2 is to 1. So for every 1 rupee of yours, we can take maximum 2 rupees from outsiders. So that's why this ratio has a standard ratio of what? 2 is to 1. Okay, guys, are you guys trying to understand this? This ratio is 2 is to 1. Okay. Standard ratio. In examination, what should we do? In examination, guys, this ratio should always and always be lower the better. So lower the ratio, the better it is. Okay, lower the ratio, the better it is. Lower the better. In examination, this ratio should always be lower the better. But we can always counter argue like this. If this ratio is lower, it indicates that there is, if this ratio is lower, it indicates that there is no risk in the company. But also, can I say that the company is not utilizing its credit worthiness? Okay. So hence we can also say underutilization of credit worthiness. My dear students, I am explaining you all these things from the perspective that if in examination they ask you MCQs as well, that a lower debt equity ratio also indicates dash. It indicates higher credit worthiness, it indicates higher solvency, it indicates lower underutilization of credit worthiness. So I hope you guys are trying to understand that if this particular ratio is very low, then of course the risk is lower, but we are not utilizing your credit worthiness. See, every company has some credibility on the basis of which banks are offering loan. And I'm telling you that some part of loan is actually good in the business, provided that you are utilizing the loan adequately for the purpose of expansion and growth. So let's say, for example, that if you have taken loan where the cost of capital is 8%, so bank is charging you 8%. But with that amount, if you're utilizing in a project and that project is offering you a return of 15%, don't you think that taking loan is beneficial for you? Why? Because you're just bearing a cost of 8, and on the contrary, you are earning a return of 15%. So your return is greater than the cost. So should we go for it? Come on, yes or no? Of course, yes, we should go for it. So what I'm trying to explain you here is that whenever we have a favorable financial leverage, whenever we know that the returns which we are going to generate is higher than the cost of capital, then we can take debt in our capital structure to the maximum extent of 2 is to 1. And if bank is ready to offer you based on your credit worthiness, should we go for it? Come on, yes or no? Of course, yes, we should go for it. Are you guys trying to understand all these things? Okay. So finally, what's the conclusion, guys? The conclusion is like this, that whenever we are dealing with your debt equity ratio, the word debt actually means your long-term debt, and your word equity means your equity shareholders funds. The ratio for this is long-term debt upon equity shareholders funds, where 2 is to 1. I have explained you this in much maximum detail possible. What is the meaning of your long-term debt in equity shareholders funds? Which all things are included? Equity plus reserves minus miscellaneous expenditure not written off. This ratio, if it is lower, then it is good. It indicates that there is good solvency. It means that the risk is lower. If this ratio is extremely high, then can I say that higher this particular ratio, it means that there is a chances of insolvency in the company. Okay, because then the risk of repayment will be higher. So this is nothing but your debt equity ratio. Acha, in examination, what are you going to do? lower the ratio, better it is. So if there are two companies, one even with a ratio of 2:1, and second if the ratio is 0.5:1, still will we select 0.5:1? Come on, yes or no? Yes, sir. We are going to select that. Okay, we are going to select 0.5:1. Now, my dear students, this was your debt equity ratio. The next ratio which we have is called as your capital gearing ratio. Capital gearing ratio. Now, you must be wondering, sir, what is the meaning of the word gearing here? So, gearing here actually means your risk. Okay, risk. Now, what is the risk involved when we are structuring your capital? Okay. So, think that, guys, you are a CFO of a particular company. And when you are a CFO of a particular company, always remember like this, that we are going to raise funds in a way where we can take the money from debenture holders, we can take the money from preference shareholders, we can take the money from equity shareholders, also we can take the money from banks, long-term loans. Okay, so these are the different sources. You know, what is the common part in the first three sources which I've written? That is long-term loan, debt, and preferentials. What is the common part here? Guys, the most common part here is that all these three financial instruments or all these three sources of funds are going to bear some fixed commitment. They are going to bear some fixed commitment. Long-term loan, debt, and preference shares, they are going to bear some fixed commitment. When we are taking loan from bank, are we going to give them interest? Come on, yes or no? Yes, sir. So there is a prefixed fixed rate of interest which is given to you. If you have issued debentures, is there going to be any fixed rate of interest? Yes or no? Yes, sir. So there is going to be some fixed interest here as well. When we are taking the money from preference shareholders, are we going to bear some fixed commitment there? Yes, sir. There is going to be preference dividend. So what I'm trying to make you understand here is that every source is going to bear some cost. Come on, yes or no? Yes, sir. It's going to bear some cost. And guys, if it is your fixed cost, then don't you think that there is some kind of risk which is involved in the business? Come on, yes or no? Yes, sir. What kind of a risk? That we have to compulsory do business to meet our fixed obligations. We have to compulsory do business so that we can repay loans. We have to compulsory do business so that we have to meet your preference dividend. Wherever there is interest, wherever there is preference dividend, you know, in all these particular situations, we have to bear some fixed commitment. And whenever, my dear students, we have to bear some fixed commitment, the risk automatically arises. And why does the risk arise? Because we have to meet that particular fixed commitment. We have to do the business by taking risk also. See, if a capital structure only has equity share capital in it, you don't have to worry about risk. Why? Because we don't have to give any equity dividend mandatorily to our equity shareholders. We are not going to give that. So, my dear students, whenever we are talking about equity shareholders, there is no equity dividend which we are going to give it to them. It's not mandatory. So, if suppose tomorrow your business is not doing good, it's okay. You don't have to give any fixed commitment to someone. But if you have raised your money from long-term loan, from debentures, from preference shareholders, you have to definitely give them their fixed commitments. And in that particular case, those fixed commitments are going to cause risk in your business. You have to compulsory earn for them. You have to take risk in the business also and earn for them. And if you don't repay to them, then these people will come and take away your money. Or will take away your assets. If suppose these debentures, long-term loans, these are secured in nature, are they going to take all these things back from you? Come on, yes or no? Yes, sir. So always remember like this: long-term loans, debt, preference shares, are they going to have an inherent fixed commitment risk? Come on, yes or no? Yes, sir. Equity share capital, is there any risk involved? Then the answer is no, sir. Because equity dividend is not fixed commitment bearing. Okay. So capital gearing ratio will help you to identify risk. And what is the risk here? The risk is to check how much money you have taken from fixed commitment and how much money you have taken from non-fixed commitment. Okay. So you can just make a note of this. It measures risk. It measures risk pertaining to funds raised from fixed commitment. Thank you so much for all the appreciation. It measures risk pertaining to funds raised from fixed commitment as compared to funds raised from non-fixed commitment. Okay. So guys, what is this ratio? This ratio is defined like this. It is defined like debentures or debt plus preference shares. Divide that by equity shareholder funds. So how is this ratio defined? Debt plus preference shares, which we are going to divide it by your equity shareholder funds. So fixed commitment upon non-fixed commitment sources. So we have debt plus preference shares, and we are going to divide that by your equity shareholders funds. So my dear students, if a particular company has taken loan, let's say amounting to 10,000, and they have taken money from preference shareholders amounting to 90,000. And suppose their equity shareholder fund is just 50,000. So can I say this ratio will become 1 lakh upon 50? So this ratio will actually become 2:1. So for every 1 rupee of equity shareholders funds, there is 2 rupees of your fixed commitment sources. Okay. If suppose there is another company who has taken only 10,000 rupees from debenture holders and their 90,000 rupees comes from your equity shareholders funds. So can I say now this ratio will become 10,000 divided by 90,000? So this will now be 0.11:2. Are you seeing that in company A and company B, B has lower element of risk? Come on, yes or no? Yes, sir. B has lower element of risk. So why B has lower element of risk? Because B has taken more funds from the source in which it does not have to pay fixed commitment. And money taken by A from debt and preference shareholders, they are definitely going to have higher element of risk. Come on, yes or no? Then the answer is yes. Why? Because we have to meet your fixed commitments there. We have to meet your interest, your preference dividend, all those obligations there. So my dear students, if this ratio is lower, it indicates lower risk. If this ratio is higher, it indicates higher risk. It indicates more funds are taken from fixed income bearing securities, fixed interest bearing securities. Are you guys trying to understand this part? Okay. So your capital gearing ratio will always measure the funds taken from fixed sources divided by non-fixed sources. So that's why we have debt plus preference shares, which we are going to divide it by equity shareholders funds. Okay. So in examination, obviously, what is going to be your view? The view is going to be lower the better. I hope you guys are writing it down along with me while watching the video itself. Okay, because that's a very, 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 very important thing. Very important activity. Don't wait for the notes to be uploaded and then to be copied. It's very important that you solve right now, write down, prepare the notes immediately along with me. Okay. So lower the ratio, the better it is. This is nothing but your capital gearing ratio. Okay. Then, my dear students, we have something which is called as your last ratio. Okay. Last ratio for balance sheet ratio. And this ratio, we will call it as proprietary ratio. Okay, what is the name of this ratio? Proprietary ratio. Okay, last ratio of the balance sheet ratio. So balance sheet ratio actually has 7 main ratios. The first one which we studied was current, then it was quick, then it was super quick. Then the fourth ratio was your stock to working capital ratio. Then your fifth ratio, debt equity ratio, sixth ratio, capital gearing ratio. Debt equity, what is the proportion of debt as compared to your equity shareholders funds? And your this particular ratio, which is capital gearing ratio, how much money you are taken from fixed sources divided by non-fixed sources. So we have here fixed sources is debt, preference shares, non-fixed sources is equity shareholders funds. Now we are going to deal with proprietary ratio. So what is this proprietary ratio? It will tell you that how much money in the assets is blocked from proprietors funds and how much money is blocked from outsiders fund. So this is something which is called as a proprietary ratio. Okay. So now we will see that how much money in the assets is from the proprietor and how much is from the outsiders. Okay. So we'll discuss this. Now, proprietary ratio. So your proprietary ratio deals with your proprietors funds upon your total assets. Proprietors funds upon total assets. Okay. So basically, what does it mean? It means that 1 rupee of your total assets, which is appearing on your balance sheet asset side, how much is it financed by the shareholders of the company and how much is being financed by outsiders of the company? Okay. Means from your debt part. So your proprietor actually means your shareholders and your total assets is nothing but your fixed assets plus your long-term investments plus your current assets. Have you heard about long-term investments? Yes, long-term investments which appears on your balance sheet asset side. So on the balance sheet asset side, which all things we have? We have plant and machinery, land and building. We have companies long-term investments means the company has made investment in some other companies. So we will be having long-term investments. Then we will have stock. We will have debtors, right? Then we have prepaid expenses. Then we have cash, etc. Okay. So all these are your assets which appear on the balance sheet asset side. Come on, yes or no? Yes, sir. In this particular ratio, we need to check that in this total of assets, how much money shareholders are blocking it and how much money is blocked by some others. That is nothing but debenture holders, your banks, your long-term loans, etc. So let's say, for example, we have total of asset side as 1 lakh. And here on the liability side, we have equity share capital, we have reserves and surplus, we have preference share. Now, all these are the shareholders of the company. Guys, there is a difference between shareholders and your equity shareholders. Can I say that equity shareholders only and only deals with equity share capital, reserves and surplus minus miscellaneous expenditure not written off. But shareholders, it's a generic term which also includes preference share capital in it. So whenever I'll be using the word shareholder fund or proprietor funds, can I say I'm talking about inclusion of preference share capital in it? Come on, yes or no? Yes, sir. But whenever I'm only and only talking about equity shareholders, then my dear students, I'm not going to take into consideration preference share capital in it. Okay. So what's the difference between equity shareholder funds and shareholders funds? So equity shareholder funds and shareholder funds. Will your equity shareholders funds include your equity part? Yes, sir. Will your will it include your preference part, preference share capital part? No, sir. Shareholder funds, will it include your preference share capital part? Yes, sir. Always and always understand like this. In equity shareholder funds, there is not going to be any preference share capital. In shareholder funds, definitely there is going to be some preference share capital. Okay. So whenever I'm talking about shareholder funds or proprietors funds, then will it include your preference share capital also? Come on, yes or no? Yes. So suppose your equity reserves and preference shares together comprise of, let's say, 50,000, and your long-term loan comprises of 50,000. So can I say that the ratio will now become 0.5:1? It indicates that for every 1 rupee of your total assets, 50% is from the proprietors. So 50% is from the proprietors means what? 50% is actually going to be from your shareholders. And can I say balance 50% is going to be from your outsiders? Come on, yes or no? Yes, sir. That is going to be from your debt. So we are going to study each and every ratio in so much of detail, though it is going to take time, but we are going to comprehensively do it, each and every aspect. So for every ratio, I'm trying to give you some of the example also, and what is going to be the ingredients of it. See, one of the way of teaching you is very simple, where I'll be just taking current ratio CA upon CL, telling you this is the standard ratio, higher the better, that's it, and wrapping it up very early. But if you study in detail conceptually that why this ratio, if it is higher, then what is the consequences of that, if this ratio is extremely higher, then it deals with inefficiency. If it is very low, it deals with insolvency. All these important parts, why stock and your uh, prepaid expenses, they are treated as non-quick assets. Also explained you why debtors, they were treated as your quick assets and not something else. So guys, all these things play a very, very, very important role for your conceptual clarity. If tomorrow you are my student and if someone will ask you that, chalo batao, in your quick ratio, why is debtors not excluded? Why is debtors not treated as non-quick asset? Right? So you have an answer. The debtors, whenever we want to convert that also into cash, into liquidity, right? We offer them discount, which is a compensation of time value of money. So in real terms, there is no loss in. So all this, you will not find it anywhere. It's not written in our books as well. Okay. But from other interpretations and understanding, from the in the chapters like receivables management, we'll be discussing this in detail. So there you will understand, how this particular cost of carrying debtors are important for you. Okay. So all these ratios, very conceptually, each and everything will be discussing in so much of detail. Okay. And if you're watching the video till now, if you like it, then please press like and comment on the same so that, others can also be aware about it. Okay. And they can take maximum advantage of this live match. Okay. Chalo. So proprietary ratio, we have shareholders funds, which we're going to divide that by your total assets. So we have, we have equity share capital reserves, preference shares, etc. Everything. Okay. Of course, if there is any miscellaneous expenditure not written off, you have to subtract that as well. So your shareholders funds actually deals with what? It deals with your equity share capital plus reserves and surplus plus preference share capital. From this, we will subtract miscellaneous expenditure not written off. Any preliminary expenses not written off. We are going to definitely subtract that. Okay. Now, my dear students, this ratio, okay, by the word total assets, what do we mean? We mean Whenever I'm talking about total assets, what do we mean? Total assets actually comprises of what? It comprises of your plant and machinery, that is fixed assets, plus long-term investments, plus whatever is your current assets. We have to take that into consideration. Okay, all this will be forming part of uh, your current assets, your total assets, and then we have to check that how is it financed. So this total assets, let's say for example, is 1 lakh, and your proprietor's fund is 50,000. So what does it indicate? Balance 50,000 has come from outside. Guys, if this ratio is higher the ratio, can I say that better is the stability? Better the stability. If this ratio is higher, it means that the stability is also higher. There is good long-term stability. It means that maximum amount is actually being financed from your own funds. So this brings stability in the business. If tomorrow, if I know that my assets are being financed from my own money, I don't have to worry. Even if suppose there is any kind of problem which is appearing outside, it's okay, no problem. I still have my assets with me. I don't have to take risk in the business and do it, because there is no fixed obligation. I have to pay it anywhere else. Now, let's say during COVID, there was pandemic. So many businesses were shut. They were paused. But if my assets are being financed from my own funds, I don't have to worry at all. Why? Because these assets are financed from my own funds. Even if tomorrow there is going to be any kind of problem, if I'm not able to do the business, still I have my self-financed assets, some of which I can sell it and continue and sustain. And even if suppose I don't sell it, I can keep the business with me. I can keep those assets with me. So if this ratio is higher, it indicates that the stability is also going to be higher. Okay. Higher. So in examination, this proprietary ratio should always be what? It should always be higher the better. And the maximum this ratio can get is always 1:1. If a particular company has a proprietary ratio of 1:1, what does it indicate? It indicates that the entire funds are self-financed. If this ratio is 1:1, what does it indicate? It indicates that the entire funds are self-financed. Okay. It means for every 1 rupee of your total assets, we have entire 1 rupee of your shareholders fund. So it's a good way to deal with. Okay. If this ratio is extremely low, it means that the assets are being financed from outsiders much. Okay. So these are your 7 main important ratios, okay, which I want you all to understand it very thoroughly. Okay. So your balance sheet ratios, okay, your balance sheet ratios, which we have discussed today, okay, has 7 main ratios. What are the 7 ratios? Current ratio, quick ratio, super quick ratio. And current ratio, quick ratio, super quick ratio are actually going to go hand in hand. They explain you the liquidity position only. Current ratio, it helps you to understand short-term solvency. Hello, short-term solvency. Then when we are talking about quick ratio, it deals with your quick ratio deals with immediate solvency, right? And whenever we are talking about super quick ratio, we are talking about actually how much money do we have right now to repay 1 rupee of your current liability. Okay, money available right now to repay your current liability. Then we have fourth, which is something which is called as stock to working capital. Then we have something which is called as debt equity ratio. Then we have capital gearing ratio. Can I say debt equity and capital gearing ratio? Both this ratio will go hand in hand. Both are going to measure the risk only. Both should be lower the better. Okay, so both of them are measuring risk. Debt equity takes into consideration debt upon equity shareholders funds. And capital gearing takes into consideration whatever is your debt plus preference share capital, which we divided by equity shareholders funds. So fixed commitment upon non-fixed commitment. And then we have something which is called as proprietary ratio, which is proprietor funds upon total asset. That is how much money of the total assets is getting blocked with the help of your proprietors. If this ratio is extremely high, it indicates that good thing. Our assets are financed from our own funds. If this ratio is very low, it indicates that, oh my God, there is going to be some insolvency problem in future. Okay. So all these ratios in examination should always be higher the better. These two ratios should always be lower the better. Stock to working capital, if it is high, what does it indicate? That the liquidity is lower, right? And proprietary ratio, if it is higher, it is considered good. Higher the better. Because guys, if this ratio is higher, what does it indicate? It indicates that our assets is actually financed more from our own funds. So guys, this is the content which we are going to discuss. In this entire regular series, each and every ratio which we are going to study, in-depth analysis. Every ratio which we'll be studying, we are discussing what is going to be the outcome of it, why these things are included, and I've also discussed that certain things, why are they not included in the ratios as well. Okay. So all these things are extremely going to be help you to fundamentally build your strengths when we're going to deal with ratio. And I don't want you to remember any kind of ratio. Don't rectify, don't remember any ratio. Just conceptually understand the logic behind each and every ratio. And I've told you by different names also. So if they tell you that let us measure the short-term solvency position of the company. How are we going to measure the short-term solvency position of the company? Then we will measure it with the help of current ratio. So even if they twist and ask you, you all know what is going to be the outcome of it. If they ask you what is the immediate solvency position, we know it's quick ratio. If they ask you what is the liquidity position, then we have super quick ratio. Okay. So quick ratio, we have different names for that as well. Quick ratio is also known as your something which is called as your absolute this quick ratio is also known as your acid test ratio. One of the most common ways, acid test ratio. So sometimes they will ask you what is the acid test ratio. So it indicates what? It is nothing but your quick ratio which we need to solve. Okay. So these are the 7 balance sheet ratios. I hope you all have understood this very thoroughly. Okay. And the notes will be available in the description. So every day in the similar manner, we are going to meet from 2 to 4 and we'll be discussing these ratios. Tomorrow we'll be discussing more ratios. We'll be discussing P&L ratios, etc. Okay. And tomorrow my objective is to complete all these ratios first. And then we will be finally, then starting with the practical problems as well. So every practical problem which we are going to solve, we are going to solve it, step by step. This particular entire champion batch is meant for the students who are conceptually poor in FM or who are studying FM for the first time. Entire batch will always be taken in English, 100% English. So students across the country, they will be, be able to understand all these things which we are going to solve here. And this is actually a zero nonsense batch. Okay. No time pass here, only pure content and good value. Okay. Everything from the study module, will it be covered? Yes, sir. Everything from the RTP, MTP, I'll try to cover as much as possible. If not, there will be definitely some other videos which I'll be posting, which will cover so many different things and other things as well. So regarding the coverage part, don't worry. Also, the questions which we'll be attempting here, these are going to be from past examination questions as well. And majority of the questions will be solving it in front of you, all the questions practically step by step we'll be discussing that, we'll be solving that. So it is going to be one stop solution for all your FM needs. As I've mentioned here, our objective is scoring 50 on 15 FM. My past students have done it. You all can also do this. But consistency is the key. Keep on watching the videos regularly, thoroughly. You know, every time you have to watch the video, make notes. That is very, very, very important. Okay. And solve it with me. You just don't have to see the videos. Alone watching is not going to help. Prepare notes. And while solving, also prepare colorful notes. Okay. The things which you feel they are important, something which I have defined it properly, then please make a note of this in a red pen. It can definitely help you when we'll be revising it. So everywhere I'm going to teach like this. First, there will be theory part. Then there will be examples which will be explaining the theory part. Then there will be practical questions which will be solving. Then there will be revision towards the end, as we have revised today all the 7 balance sheet ratios which we have done. Extremely comprehensive. Okay. So you have to watch it in this particular way. So that's it, my dear students, for today's lecture. I hope you all have enjoyed it, whatever we have seen. Okay. Keep liking, sharing, and commenting on this particular videos and the series of videos which will be doing it. Wish you all the very best. Okay. God bless you, everyone, and take care. Keep on watching the videos like this. Keep on watching this video series if you want to be conceptually clear in your financial management. Okay. All the ratios, all the chapters, will be discussing it in so much of detail, covering all the concepts. And if you're watching these videos and solving it, that's it. You don't have to see anything else more apart from this. Only this much you have to do. Of course, case studies and MCQs will also be coming in the subsequent lectures. Okay. So I'll explain you in a way that how these case studies needs to be met. How are we going to solve these case studies? Okay. Recorded, of course, YouTube, you can see this particular part as well. Okay. And it's part of our course for our regular batch students. So this advantage, I want you to take as much as possible, as maximum as possible. Share it with your friends. For those who are in need, one-stop solution of your financial management. Okay. Fine. So, of course, MCQs and all those things, I'll teach you how to crack it as well. And also at the same time, we will be, uh, you know, uploading this in our Telegram channel as well. So on our Telegram channel also, you can join that. You can follow me on Instagram, because sometimes very randomly also I put some MCQs on the Instagram as well. Okay, but there is a drawback in Instagram that I can't paste the entire case study there. Okay, so for that I need a medium, and that medium we can use it by Telegram. So you all can just subscribe to that channel, and after the end of every chapter, whatever case study I'm uploading it, you all can download the case study and then solve the MCQs based on that as well. Okay, so this is something what you all can do. I hope you all have enjoyed it. Do share your experience in the chat box, in the comment section as well. Okay, so that I can, it motivates me to further do it in much better way. Okay, so especially for South India students, you all don't have to worry at all, because I was receiving many requests from the South India students, ke, sir, regarding our live inter-CA live batch, we don't know, sir, where to watch, what to do, because they were facing language issues. And I use basic, adequate, not high for the English as well, so that students across the country can see it. Okay. And always remember that the paper which you are going to attempt is always going to be in English only. Okay. So the learning, if that is going to be in English, so your thinking will also be developed in your English language. So when it comes to solving it, that flow of the question will be in English. So everything becomes much more convenient for you. So that is an advantage also of sometimes listening to English lectures. Okay. that can really help you to understand this. Fine. Okay. So, my dear students, anything else? If you are there on Zoom or on this YouTube, and if you want to ask me anything, you all can definitely let me know about the same. Okay, students, so we will wind up now. See you guys tomorrow again at 2 p.m. We'll continue this further. So that's it. Bye, guys. Take care. See you. Bye.